Well, welcome to Chapter 12. In Chapter 12, we'll talk about cash flow. And basically, it's a continuation of Chapter 11. Chapter 11 was the capital budgeting chapter. And he just gave us the cash flows to figure out for future time periods. And this chapter is more about how do you come up with those cash flows. So instead of just giving them to us, in this chapter, we'll have to figure out what those cash flows are and figure out what a relevant cash flow is, and then basically factor risk into it. Okay, so the chapter gives a great example both in chapters 11 and 12 of what different kinds of projects are. You can read that on your own. I don't have to cover that with you. And just some of the issues about coming up with a project, choosing a project. Sometimes you're told you have to do a project. It's government mandated or regulated. Sometimes you have choices. Usually you have choices, but just kind of be thinking about those behind the scenes. For the project we're looking at here, we have a depreciable cost, equipment we're going to buy of $200,000. Shipping and installation to get the equipment and install it is $40,000. We're going to increase working capital inventory by 25 and payables by 5 because we're going to be able to manufacture more stuff, and therefore we have to buy more raw materials. That's our inventory, and account payable goes up as a result of that. And results in operations is with this product I'm manufacturing, I'm going to sell 100,000 units per year at $2 per unit, and my variable cost is 60% of sales. Okay, so that's the project that we're taking a look at. A 4-year project, depreciable life would be MACRS is MACR's Modified Accelerated Cost Recovery System. It's the IRS rules about depreciation. And then salvage value of what this will be worth after 4 years is $25,000. So if we're going to go back and spend $200,000 on equipment, we use it for 4 years, and after 4 years, we'll dispose of it for $25,000. That's what we expect. Tax rate's 40%, and they're just giving us the WACC again at 10%. So remember, in Chapter 11, we had to compute the WACC, and now, or Chapter 10, we had to compute the WACC. In Chapter 11, we used the WACC to decide to undertake projects, and now we're computing what the cash flow is in this chapter. So determining project value, and that's what this chapter is all about, is what are those cash flows. So we calculate the annual operating cash flows, we identify changes in net operating working capital, and we calculate the terminal value. So terminal value is at the end of the project. This is a 4-year project. What is the after-tax salvage value and recovery of net operating working capital? Net operating working capital would go back down because we're not making this product anymore, so we don't need the raw materials. That would just go away, and the payables would go away, and so on. So initial cost, future cash flows in year 4, terminal cash flows, which are the salvage value, after-tax salvage value, we should say, and then the return of the net operating working capital, or recovery of that, I should say. Okay, so for the initial year, in year 1, we have to find the change in net operating working capital. Inventory goes up by 25, funded partly by a rise of accounts payable of 5, so that change is 20,000. Okay. We are also going to spend 200,000 to buy the equipment and another 40 to install it. So the capital expenditure, the CapEx, capital expenditure is 240. That's everything that we expect to pay to buy the machinery, get it installed, ready to go. So 240 is we flip a switch and it works. Okay, that's the whole point of that. So we have to include all those costs to get it ready to work. My net operating working capital then again was 20,000 extra I have to spend to buy inventory, raw materials basically. And so my initial cash outlay is 260. So I need 260 of cash on hand to fund this project. Then I determine depreciation, and we're using the MACRS rate. Okay, and that just comes from tax tables. They will give you those when you do this work in Applio. So a 3-year asset is depreciated over 4 years using a MACRS half-year convention. So they give us the rates, and they're always accelerated. You take a lot of depreciation right away and just a little bit towards the end. And the basis was 240. Remember, and the basis is not including the inventory number. The basis is the capital expenditure number. Okay, that's what we depreciate. We don't depreciate working capital. So the basis is 240, and my depreciation then ultimately ends up being 240. And then we do the cash flow analysis. Okay, so remember that we expect to sell 100,000 units of the product at $2 each. So the revenue is 200 minus operating cost, which was 60%. They told us that the variable cost is 60% of revenue. So that's where that 120 comes from. 60% of 200 is 120. My depreciation expense comes from this table right here, 79, 108, 36, and 17. Okay, so you can see what the numbers are. That gives me an EBIT, earnings before interest and tax. Okay, and so you can see it's a small positive, a big negative because I had a big depreciation year, and then positives. Okay, my tax rate's 40%. You can see what the calculation there is. So my EBIT, my earnings, or my EBT, earnings before, my EBIT multiplied, or let me say that right. My EBIT after tax, let me say it that way. EBIT after tax, you can see those numbers here. I add back depreciation because the thing about depreciation, it's a non-cash number. So I add that back, and so I get a cash flow then of 79, 91, 62, and 54. Now we're not quite done yet, but that's the initial cash flow based on just my operations of selling 200,000 units of this product. The next thing is to compute what the terminal cash flow is, the cash flow in year 4. Remember that in year 4 the project will be done, and we expect to be able to sell this equipment used for $25,000. So we depreciate it all the way. This right here means we depreciate it all the way. This table here, the cost was 240. We depreciated it away at 240. The 240 is the sum of these 4 numbers right here. And so when I sell it after 4 years, it has a salvage value of 25 and no book value, right? It's been fully depreciated. So I have to take a tax. I'm going to have a gain of 25,000. Think of it like that. So it's the sale price minus book value. Book value 0. So 25,000 gain. 40% tax, 10. So I'm going to have a net cash receipt of 15,000. Plus I recover my net operating working capital, right? I'll pay off my payables. The inventory gets used up. That will then decrease. So I get it, recover that. That's a positive 20. So my terminal cash flow is 35,000. Okay. So my cash flow in year 4 is my EBIT plus depreciation minus my CapEx minus change in net operating working capital, and I get 89.7. So a few questions then. How is the net operating working capital recovered? Is there always a tax on salvage value? Is a tax on salvage value ever a positive cash flow? Oops, I thought I was going to answer the second question. Net operating working capital is recovered by not having to buy more, by paying off the payables and just using up our store of inventory. And now I don't have to carry that, so I've got less asset, I've got less payable. I recover that 20,000. Is there always a tax on salvage value? Only if it's a capital gain, right? And in this example, we fully depreciated the asset, so the book value was 0. So it's always the cash received minus the book value determines that. We could take a loss, so the tax could be a positive if we did take a loss. So if we sold this at a capital loss, there'd be a positive tax. That'd be a cash inflow. Should financing effects be included in cash flows? And the answer is no. Dividends and interest expense should not be included in the analysis. The financing effects have been taken into account by using the WACC. Okay, that WACC, remember, took into account interest expense, dividend payments. It took in all the average cost of capital is included in that. So as long as I've got a good WACC number, I'm good. I don't have to deduct interest or dividends from this project, from financing. Now, in this example that we looked at, this 200,000 per year and the 240,000 cost, we didn't talk about where did the money come from, right? We didn't say we issued debt, we sold stock, didn't bring that up. We just said we've got this project. here's the cash flows. Okay, and we'll apply the WACC methods then to compute NPV and IRR and MIRR, all that kind of stuff. Should a $50,000 improvement cost from the previous year be included in the analysis? And so the question has to come into play too about what a relevant cost is and what kind of cash flows that I include in an analysis. Okay. So it says here previous year. So we've got, let's just say, an empty factory space, and we're deciding what to do with it. And this empty factory space, we realized we could spend that $240,000 on some equipment, and then sell a product at $2, 100,000 units, make a bunch of money. Right? That's one thing we could do. It says, should $50,000 improvement cost from the previous year be included in the analysis? And the answer is no, because it was a sunk cost. Okay, so the chapter will have a lot of terminology in it. Make sure you know that, but sunk cost is one of them. A sunk cost is something that's happened in the past that cannot be changed. Okay, when we compute cash flows, we only care about incremental cash flows, incremental investment. Change in, okay? That $50,000 happened in the past. It's not relevant to what we're doing today, and it does not change anything that we're doing today with this new analysis of buying equipment, okay? So we don't include this in the analysis. So relevant cash flows, sunk costs are important factors to, or important terms to know about this chapter. Another hypothetical is we've got this empty space. We could fill it with equipment, or we could actually even just lease it to somebody. Maybe somebody comes to us and says, we need to expand. We don't want to build anything right now, but we know you guys have some empty floor space. Could we just lease it from you for a while? And we'd have to go, maybe, right? We'd look at the cash flow, look at, figure out what that would be. And so this example is, if we could lease that for $25,000 per year, would that impact the analysis? And the answer is yes. By accepting the project, we're giving up an annual $25,000 cash flow. So it's an opportunity cost. So remember that we've got choices. We could choose to rent this out. We could choose to buy equipment and make a product. We have to decide which one makes more sense. But in this example, this is very relevant, and this is an opportunity cost. So I'm giving this up to be allowed to manufacture the product. Now, if you're looking at this from an accounting perspective, it makes no sense, right? Because an accounting perspective would be, if I buy the equipment, I don't even care about this because there's no journal entries, there's no impact on my financial statements. But in finance, we care, because in finance, you're trying to figure out, are we increasing the value to the firm? And so we've got two choices. We can buy equipment or lease the space. Which one is best for our company? So we're going to charge the new product, the new project of buying equipment. We're going to deduct basically this cash flow from that to say that this is an opportunity cost, which you wouldn't do in accounting, but in finance you do. So this is a relevant cost. So we have to tax affect that, because if we were receiving $25,000 per year in a lease, that'd be lease revenue, it'd be income to us, that'd be taxed at 40%. And so the net benefit is $15,000. The after-tax benefit is $15,000. So if the new product line decreases the sales of the firm's other lines, would this impact the analysis? And absolutely yes, right? And again, you wouldn't really take that into account in accounting if you're building financial statements, but in finance, where you're trying to predict the future, you're trying to make the best decision to add value to your firm, the answer would be yes. So if you believe that this new product line would rob sales from other product lines to some extent, then yes, that you would definitely charge that to the product. It's called an externality. And the chapter does a really good job of explaining and giving you some examples of some externalities. You can have positive or negative externalities, by the way. And I've given examples previously of, you know, a store coming to Sioux Falls or wherever you are for the first time, and then adding a new location across town, knowing that you're going to be robbing sales from the existing store, because people who live closer to your new location are going to go there more often and not make the trip across town to the other store. So you're going to rob sales from your existing store, but the point is the new sales big enough to handle that and make the project, a positive cash flow. And you're not going to build a new store unless you take that into account. You can have positive or complements too. The book gives a good example of iTunes with the iPhone and the iPod. iPods, when they first launched, became very popular because of iTunes and the ability to buy music online and put it on your iPod. One without the other would not have made any sense. That they would have, they only exist together because they allow a symbiotic thing to happen. The ability to put music easily and conveniently on a small device you can carry around in your pocket. So complements would be an example there, or they can be, or substitutes would be a negative. So externalities can be positive or negative. Just be aware of that concept. They've got lots of good examples in the book about externalities, so just make sure you take a look at those. So with this here, then we've gone ahead and we've coming back to our initial analysis of what the cash flows are for the project. The initial 260, which was 240 of capital expenditure, 20,000 of working capital, and then my future cash flows. Then we can go ahead and just use our capital budgeting methods that we came up with in chapter 11, and go, here's how we, here's how they work. So remember that our WACC was 10%, and so we have a negative NPV, an IRR below 10, an MIRR below 10, and payback is 3.3. And that kind of shows you how payback can be kind of like so-so when it comes to making a decision. Okay, I get my money back in 3.3 years, but it's really not a good project. I'm going to lose value. I'm not making a return above the WACC. Payback is just information, but you would never make a decision based on payback. If this project were a replacement rather than a new project, would the analysis change? Yes. The old equipment would be sold and new equipment would be purchased. And then we look at the incremental cash flow, would be basically the change from the old situation to the new. Again, incremental means change. How did the old situation change versus the new situation? In this example, it was nothing to something, right? If you just kind of throw out the leasing, the opportunity cost for leasing, if you just kind of just take that out, those were just more hypotheticals. But if you just go to the base case of, here's my cash flows, if I just buy this equipment, buy the inventory, manufacture a product and sell it, this is what I get. But if I were replacing an existing product line with new machinery versus old machinery, I would look at what's the change, what's the difference between the two. Okay. If the old machine was sold, of course, the firm would not receive the salvage value at the end of the machine's life. This is the opportunity cost for the replacement project. Okay. So we have to also look at that. Okay, so take into account all things that changed versus the new. Okay, so a lot of cash flow deals with risk. Okay, there's lots of risks when it comes to cash flows. And there's the three kind of right there. We'll talk about each one in more detail. Okay, so standalone risk. The risk of the project if it was operated independently, usually measured by a standard deviation. However, it does ignore the firm's diversification among projects and investors' diversification among firms. So it doesn't really take into account the fact that a company, most companies have multiple product lines, they're doing multiple things, not just one thing, and most investors own several types of investments. Corporate risk is the project's risk when we consider the firm's other projects. How diversified is the corporation, the company, among all the different kinds of projects and the different kinds of risk that it has to operate under. So it's a function of the project's NPV and the standard deviation in correlation with the returns of other projects within the company. Market risk is a project's risk to a well-diversified investor measured by the project's beta and considers both corporate and stockholder diversification. Okay, so just be aware of those three terms. Which is most relevant? Market risk is the most relevant for capital projects because management's primary goal is shareholder wealth maximization. Okay, so that's the most relevant one. However, since corporate risk affects creditors, customers, suppliers, and employees, it should not be completely ignored. Okay, because market risk is the focus of investors, right? And that's really what this chapter is about. Well, I should say, really, this whole class is about, is maximizing the value of a firm to benefit shareholders. Okay, but we still have to take into account the fact that a corporation does not operate in a vacuum, right? It has creditors, it has customers, it has suppliers, it has employees, all counting on the corporation to be there and be a long-term presence to benefit those all the parties in this second bullet point. Which is easiest to measure? Standalone risk is the easiest to measure. Firms often focus on standalone risk when making capital budgeting decisions. Focusing on standalone risk is not theoretically correct, but it does not necessarily lead to poor decisions. It's just the easiest one to compute, so therefore you tend to look at it the most. Are the three types of risk generally highly correlated? In other words, they move in the same direction, up or down? Yes, the answer is yes. Since most projects the firm undertakes are in its core business, standalone risk is likely to be highly correlated to corporate risk, and corporate risk is very correlated to market risk. Okay, sensitivity analysis kind of is what I call the what-if game. Okay, so you basically have a base case, and you make changes to the base case and go, how will that change my answer? You know, we could look at the base case they gave us in this PowerPoint was, we're going to sell the product at $2 per unit and sell 100,000 units per year. So what if the base case said, well, what if we can raise the price? What if that price really could be $220 or $250 or some other number? How will that change our answer? We'd have more revenues, more cash flows, and the answer might change. That's what sensitivity analysis is. If one variable changes, how does that impact the answer? You know, what we'll do. So all variables are fixed at their expected values except for the one variable in question, whatever that is. So maybe if my WACC changed, if my depreciation changed, if my salvage value changed, if the initial cost changed, if I just change one thing and hold everything else true, how does that change the NPV? And then maybe change my answer of what I'll do with the project. Advantages and disadvantages of that: identifies the variables that may have the greatest potential impact on profitability, and allows management to focus on those variables to make sure that those variables are being taken care of properly, for example. Disadvantages: does not reflect the effects of diversification, does not incorporate any information about possible magnitude of forecasting errors. But it's a good thing to do. I've done a lot of these. It's a good thing to do. Management wants to know these things. They want to know, if we do this, then what? If we change this number, then what? So you want to run several scenarios to be able to answer those questions and provide that information. But there are disadvantages to it. If inflation is a part of the equation, if expected inflation equals 5%, is NPV biased? Yes. Inflation causes the discount rate to be upwardly revised. Therefore, the inflation creates a downward bias in NPV. And so therefore, just saying, if there is inflation, we better make sure we include that in the cash flow. Okay, that better come into play if we expect inflation to be a significant thing. Okay, so they're just saying here, if we think inflation will be an issue, you can see what they did here is they just increased every year by 5%. That's all that they did. Okay, so they said inflation is an issue, so they increased every year by 5%. And therefore, the 60% of revenues changed. Everything else, the depreciation stayed the same. The EBIT would have changed, tax would have changed, and depreciation stayed the same. Okay, so but your cash flows are different now at the end. And so now we have different NPVs. We now have a positive NPV, positive IRR, positive MIRR, all above 10. Okay, so if inflation is a deal, so basically we expect that our prices will need to go up to match inflation. Now this works. Okay, so that one thing made this work out. So it says here, perform a scenario analysis of the project based on changes in the sales forecast. Suppose we're confident that all variable estimates except unit sales and actual unit sales are expected to follow the following probability distribution. And this is actually a very common thing to do in finance, is we kind of went with 100,000 units, but how confident are we in the 100,000 units? Is there a chance that we'd sell less? or is there a chance we could sell more? So the base case is 100,000, but there's a chance we'd sell less and a chance we'd sell more. And what we could do then is do an NPV on that. We could do, if we only sell 75,000, we have a negative NPV. If we sold 125,000, then we have a very big NPV, and the base case is in between the two. And what we can do then is to do standard deviation and the correlation and variation on that. And so you can see here what they're doing is they're taking the three weights, 25, 50, and 25, multiplying those by the three different NPVs and getting my 15, my base case 15. Okay, and you can do a correlation then of your variation, and that ends up to be here. So my standard deviation of all that is what this is, the standard deviation sign. And so we get 30, and then my correlation and variation is 2 when I do that. If the firm's average project's correlation and variation range is 125 to 175, will this project have high, average, or low risk? With our correlation and variation of 2, the project would be classified as high risk because normally it's between 125 and 175, and this is a 2. Perhaps some sort of risk correction is required for proper analysis. And then if this project were correlated with the firm's business, how would it contribute to the firm's overall risk? We'd expect a positive correlation with the firm's aggregate cash flows. As long as the correlation is not perfectly positive, we would expect it to contribute to lowering the firm's overall risk. If it had a high correlation with the economy, how would corporate market risk be affected? The project's corporate risk would not be directly affected. However, when combined with other high standalone risk, correlation with the economy would suggest that market risk or its beta is high. If the firm uses a plus minus 3% risk adjustment for the cost of capital, should the project be accepted? So we go back and say, okay, let's look at 13% as our new WACC instead of 10%. The NPV would be negative. If it was a low risk project, we'd go back and use a WACC of 7%, and the NPV would be a large positive where we would do it. What subjective risk factors should be considered before a decision is made? Numerical analysis sometimes fails to capture all sources of risk for a project. So there's a risk that if you get too focused in the numbers, you'll make the wrong decision. If the project has the potential for a lawsuit, it's more risky than previously thought. If assets can be redeployed or sold easily, the project may be less risky than otherwise thought. So basically, if sales were underperforming on this product line, could we use that equipment for something else or easily sell it and get close to what our value was? Then there's less risk, right? So you have to ask those things too. Or if the product we're selling could result in a lot of warranties or lawsuits, then boy, there's a lot of risk, right? So we have to price for that and risk adjust for that. So you have to think about the subjective things and not just focus on the numbers. Real option analysis, you could do a whole finance class based on real options. We're just touching on it here. The analysis of capital budgeting projects for which managers can take positive actions after the investment has been made that alter the project's cash flow. So basically, let's just say you launch a product line. What are some things that management can do if it's underperforming? Can we direct some money at marketing? Can we add a feature or two to the product that we're selling that'll make it more desirable? What are some of the options we have to meet our goals? Okay, real options are valuable, but this value is not captured by conventional NPV, and so real options are considered separately. So again, you could do a whole bunch of stuff based on that. Just know there are actions that management can make to try to make sure you're meeting your goal. If we had a goal to sell 100,000 units at 2 and we're underperforming, what are some of the actions that management can take to meet the goal and exceed the goal? So abandonment, investment timing, expansion, output flexibility, input flexibility. I talked about a couple of those with our example. So abandonment could just be walking away, just cutting our losses. Timing of investment, when to get into a market, when to get out. The expansion example that this chapter used. Output flexibility and input flexibility. Can we add some features? Can we change pricing? Can we become more efficient in our operations to reduce cost? what are some of those things that we can do? So just think about any decision that management can make to affect the cash flows. Okay, so a little bit tougher chapter. Some of those risk terms are kind of just, they're hard to wrap your mind around, the standalone risk and corporate risk and market risk. As long as you know the terms, you've got a good handle on the term from your chapter, you're in good shape. This is a good chapter to maybe read more than once. Some of those terms and some of those things, you might just need to read them a couple of times for it to make sense. That's a distinct possibility. But the actual cash flow computations in this chapter are really not that tough. I think actually the computation part of this chapter is easier than some other chapters. Just the terms are a little bit tougher to wrap your brain around, I think. That's just my take on the chapter. So anyway, if you've got questions, let me know. I'll do another recording that just kind of walks you through the Excel